Welcome back to the Financial Shepherd podcast. My name is Joshua Casey Garland, certified financial planning professional, founder and CEO of Shepherd Wealth Management. Very excited to be here in home studios today as a ton of news to get to financially. I have a lot of very important topics to talk about here today. I think the viewers definitely tuned in to the right program here today. So if you're a regular viewer, welcome back. Thank you so much for your viewership. Please like, share, and subscribe the Shepherd Wealth Management podcast. If you're new, just buckle up and enjoy this one because this might be a little longer, but we're going to get to some very important topics and expectations today. So I'm very excited as we even got some comments to get to. I don't even think we got time to do a little banter here today. It looks like the Reds aren't going to make the playoffs. We'll just get that out of the way. Very happy for the first NFL kickoff weekend. My hometown Bengals squeaked out a win up in Cleveland. So all the sports stuff is now handled, and we can kind of dive into the meat and potatoes of today. But before we do, just have to acknowledge a couple of things here as we sit here on September 11th. 2025, 24 years ago, one of the greatest tragedies of American history happened. I was a ninth grade student in an art class at the time, and right around earlier mid morning, 10 o'clock ish, if I remember correctly, our teacher shut down everything that we were doing and turned on the TV, and I thought it was fake. It didn't look real to me as a ninth grader as to what had actually happened. But here we are 24 years later. I now have three daughters who weren't alive, obviously, as all that stuff happened. So a whole generation of folks will be learning, about this every year as we remember those who lost their lives on that tragic day. And in addition to that, have to acknowledge the terrible tragedy for Charlie Kirk. All of our thoughts and prayers are with him and his family, and certainly have a ton of respect for the man. So definitely rest in peace, Charlie Kirk. But with that aside, with that somber stuff to begin today, which we certainly cannot overlook, which is why I wanted to tip a cap to all that. A lot of news to get to today that are certainly going to impact markets. And as much as I would like to share my own personal thoughts and beliefs about 9/11 and the tragic event that happened yesterday with the assassination of Charlie Kirk, this just isn't the platform or program for that. So just thoughts and prayers are with all of those that were affected, and certainly hope nothing but the best for America as well as the Kirk family. So with that, we'll dive into today's program as I think the best place to start, even though we got a bunch of inflation news that I could rattle off here real quick, we'll definitely get to that and our thoughts and expectations for it. I wrote a very lengthy and detailed newsletter to clients right at the beginning of the month before we got this inflation news here today that has a lot of historical context to it. And if you're a new viewer, the reason why this show has had the success that it has, in addition to the success of Shepherd Wealth Management, we are now managing north of $160 million of money for clients across about 19 states, if I remember correctly. And the reason why we've had the success we've had over the last 4.5 years is has very little to do with myself and my team being the smartest people in the room at all times. It has everything to do with the fact that we've identified a process, thanks to the best investor of all time, Warren Buffett, who made it very clear the number one reason individual investors do not achieve the results they're looking for consistently over time is they don't have a process to control their emotions as they make investing decisions. He calls it temperament. So how do we solve that biggest problem for clients? Because keep in mind, 74% of Americans every year say the number one stress in life is their personal financial situation. So that shouldn't exist in this country. And there are other reasons that that exists. But how do we solve that problem of removing emotion from the decision-making process of individuals? Well, it starts with data, and it also begins and ends, to me and our customers, with what's the common denominator? What's the through line across every instance, good or bad, in the stock market's history? What's the common denominator? Well, the common denominator is simply this, is that human beings make the market go up, down, or sideways. And the human being, I think all of us would agree, hasn't changed hardly at all in thousands of years. Therefore, to me, it's the most predictable thing that there is when you're talking about investing. When you're investing in an environment where there's so many variables that can change in an instant, what is the one common denominator? Well, the one common denominator is humans make a market, and they're the ones that make it go up, down, and sideways. Therefore, if we can agree on that, then that is a competitive advantage as far as controlling your emotions, your temperament. Is hey, let's just understand how other human beings have behaved in the past relative to today. How have they behaved under similar circumstances that we're dealing with right now? And the only thing that's happened in the course of history where there hasn't been a precedent was March of 2020 when COVID happened. I mean, there's no other point in time in history where you can point to and say, yeah, we shut down the whole global economy for a couple of years. You can't point to history for that. But other than that, there's been a historical precedent. Now, past performance is no guarantee of future results, and investing does involve risk, including risk of loss. But that is where we begin solving that major pain point of how do I have a process when I'm participating in an environment called the stock market, where all these news headlines and variables are flying at you every second of every day. How do I control my emotions in that environment so that I can make consistently good financial decisions that will benefit myself and my family, or whatever it is, the reasons why you're investing? That's what you have to start with. Now, once you have control over those emotions, and how we do that again is based on how other human beings have behaved in similar circumstances. Well, now the risk and reward of every decision that you're about to make should be become clear, because based on that historical precedent, you should understand what the market's reaction might be short, intermediate, long term, and then what sectors drove that effect, good or bad, short, intermediate, long term, so that you can develop an asset allocation. In other words, picking investments to fit the goals and objectives that you have for your money based on that historical data. And why that's so impactful is because you now know what the risk is, what's the odds based on how these other human beings have behaved previously to the similar environments that we're dealing with today. What's the odds? What's my chance of being successful given my mandate for investing? And where can I find that success? Where should I avoid certain areas? That's what this program is all about. I don't know why. Well, I can give you my thoughts as to why the news does not provide you with this historical data the way that we do on a consistent basis. Yes, they get some things right and they post it here and there. But the main reason why the news does not focus on those positive things or remind the audience that, yeah, this feels scary, but here's the 17 other times in history that we went through something very similar. And here's what the outcome is 6, 9, 12 months later. And oh, by the way, here's the sectors within the S&P that drove that result. They never talk about that, or they rarely do. Or maybe they bring on a guest that might talk about it for 3 minutes in a segment across the 24 hours of news that they post out there. Okay, that's the reason why we have a competitive advantage here for our customers and why this show has had the success it has. So, welcome to the Shepherd Wealth Management Podcast. And Ez, let's dive right into it today. So I know we got some comments. Appreciate your comments on YouTube. Please share your questions, your thoughts, your comments. Love to give you our thoughts on it. So we're going to kick off with that, and then we'll get into some data as well as our thoughts for customers. And I'm going to point to the newsletter that we sent out to them last Friday. So, Ez, what was the I guess the comment, question, and summary that we got from a viewer, I believe, 2 podcasts ago?
Yeah, we did. It's a recent comment on a previous podcast. We post a clip of the podcast every week. So there's a lot to get through. But if you go back far enough onto our YouTube channel, you can find, any kind of podcast or any kind of questions we ever reference. So this is from a user called Lion X-Ray, and it was a lengthy comment, but I'm going to do my best to paraphrase it here. And it was on a highlight of the show where Joshua was talking about how tariff data is coming in, and currently, and this is again about a month back, right? The data was reflecting how some of the costs of tariff increases are or were at the time being currently absorbed by the companies, by major suppliers. So again, that was the data at the time, and the commenter had a different take on that. And basically, while they were acknowledging how the data showed that now, that the comment alluded to that it was inevitable that we're going to see these massive increases in costs. And We're going to have some data on this again later today, as Joshua has just said. But I want to remind viewers before we get to a response to this comment that, again, this was the data at the time a month ago was showing that there was some um, taking on the shoulders of the cost of the tariffs. And, we had no data to suggest how that was going to continue or not continue in the future. But we wanted to bring this comment up to everybody because I think it does encapsulate a kind of a macro fear that consumers and people across the country are just still waiting and embracing, just kind of almost cowering for this massive spike in inflation. And I am not the yeah. So there we go. We wanted to line X-ray. We're addressing your comment right now. So
Yeah, yeah. And now that we have updated data, let's cover that real quick. So, yesterday, Wednesday, September 10th, the producer price index, otherwise known as wholesale inflation, came in at a negative 0.1. Economists expected a positive zero point 0.3 for that wholesale inflation. So, far below economists' expectations, negative inflation, actually. The previous month reading was positive zero point 0.7. So, yes, this is a $30 trillion US economy. There's a lot of moving parts to it. Could you get 1 month's data that looks oddly different than the prior month? For sure. And this isn't the only time that's happened in history. So definitely moving in the right direction there. Core PPI came in as expected, 0.3. The previous month's reading was 0.6. So it came in half as light as what it did the prior month. So again, moving in the right direction. Today's news regarding core PP or consumer price index (CPI) headline inflation. This did come in at 0.4. Economists were expecting 0.3, and the prior month's reading was 0.2. However, the core CPI, which is the Fed's favorite measure of inflation, came in as expected, and headline CPI year over year is at 2.9%. With initial jobless claims, this is the big news of the morning today so far. Initial jobless claims being higher than expected, 263,000 versus economists expecting 236,000. So initial jobless claims moving up, which is not a great thing if that trend were to continue for certain. This is a economy here in the United States at 70% service. So consumers need to have a job of steady pay to continue to consume these services. Otherwise, that is your first leading indicator of where the economy is heading. So, not anywhere in my view close to the recession word that gets thrown around way too much on TV these days. We're still at 4.3% unemployment rate, which is by the Fed's own measure, maximum employment, even though it has ticked up a little bit. So we don't want to see that, but that's the reason why the odds of a probability for a Fed rate cut here coming up next week on September 17th is 100% lock of a cut. The only debate is whether or not they do 50 versus 25 basis points. And as I'm delivering this, there's an 88.8% chance of a 25 basis point cut, according to the Fed's own probabilities on the CME group, the Fed Watch data that anybody can pull up on the internet. And there's about 11% chance, 11.2% chance of a 50 basis point cut during next week's meeting. And then the meeting after that in October, similar numbers, 80% chance of a 25 basis point cut, 10% chance of even another 50 basis point cut. And then when we get to December, there's a 76% chance of the Fed cutting and about a 9% chance of a 50 basis point cut. So there is some probability in the October and December meeting for the Fed to hold after the cut in September. But right now, as I'm delivering this, based on the employment data as well as PPI, CPI, inflation data, it's a lock that the Fed will be cutting, just a question of how much. So getting back to the question at hand here, that was based on inflation data from a couple podcasts ago. So just wanted to provide everybody with the updated inflation figures. This article, and believe it or not, is this comes from Barron's. I know that we picked on Barron's quite a lot here over the last several podcasts, but I would also say that there's been some better writings that I find more fair and balanced. But this one in particular is a comment made by a woman named Julia Graff, and the headline says this: "The inflation panic is all wrong. How tariffs could lead to interest rate cuts." And this was written on August 14th, right around the time if I'm not mistaken, as that we delivered that podcast that delivered this question. And I've been hanging on to this for almost a month now, just to see, based on this author's comments, what actually would take place with updated data. So, again, this was written on August 14th, Julia Graff, 2025. And Julia is a former finance professional at Bank of America, State Street, and Fidelity. She now advises on energy, industrial strategy, and artificial intelligence. And here's what she had to say. Economists warn tariffs will increase prices. Some say Americans will pay about 18% more on imported goods as businesses pass the costs along to consumers. But this narrative is likely wrong. Import duties actually fuel broad inflation. Economists have missed a lesson from Trump's first term. Tariffs aren't just trade weapons, they're macroeconomic tools that can deliver targeted price signals, rebalance the economy, and lower inflation. Modern inflation commonly refers to rising prices for goods and services, but classically is actually the money supply. As Milton Friedman famously put it, inflation is always and everywhere a monetary phenomenon. Too much money chasing too few goods. By this framework, tariff driven price increases of specific goods, electronics, furniture, cars, etc., are one time price adjustments, not a signal of systemic inflation. Economists' preferred gauge of inflation is the Consumer Price Index, which tracks a basket of goods and services paid by households. Foreign goods affected by tariffs make up less than 10% of total CPI weight. I'll say that again. Foreign goods affected by tariffs make up less than 10% of the total CPI weight. The bulk of the CPI basket is services like housing, healthcare, education, telecommunications, and transportation. These aren't directly affected. Inflation in these areas, as measured by CPI, has only shown very modest increases in recent months. JP Morgan's Jamie Dimon has urged a refocus away from price levels. Quote, tariffs may drive higher inflation, but what we really want is more growth, he told CNBC last month. This is far more important than whether inflation ticks up or down a little bit. And to pause in the uh, writings here by Julia, current GDP, just so the audience knows, based on the Atlanta Fed's own work, is 3.1% in the third quarter, which is what we're in right now. We're about to wrap up Q3 here in a couple weeks when September ends. So the Atlanta Fed is saying 3.1% GDP in the third quarter. GDP, gross domestic production, historically is about 2% over the long run. So anything north of 2 is excellent. And oh, by the way, the CBO that scored the bill that was passed earlier this year was calling for 1.8 average GDP. This is nearly double that. And all the work that has taken place here regarding policy from this administration, I can't even say is fully taken effect yet. So I guess you could say the jury's still out, but the data is certainly supporting what was written here on August the 14th. Getting back to the article, quote, strategically applied tariffs can be just that, tools of recalibrating the economy. They steer consumers towards domestic alternatives and postpone non essential purchases. There isn't a tariff or a tax on something you don't buy, in other words. Getting back to the article, higher prices encourage households to spend less, easing demand and slowing down sectors that might contribute to overheating while stimulating targeted investments. In this sense, tariffs operate not just as a tax, but as a demand rebalancing tool. The key to this is scale. If applied too narrowly, the deflationary effect may be too weak for the Fed to adjust rate policy. If too broad or poorly targeted, the policy could push the economy into recession. Politically charged tariffs on Mexico, Canada, China, and India don't support growth. Their economic impact might be limited, but they surely fuel mistrust and geopolitical instability. Hence, all the headlines and surveys that show investors feel uncertain and nervous and panicked, although there isn't any underlying data to support that. I don't know how many podcasts this year we've done on that specifically as. Back to the article here. Quote, the US economy is more than 70% services, as I mentioned at the beginning of this program. The rest is goods. Of those goods, only one third are imported. So while tariff exposure is real, its effects should be relatively small. Analysts put the annual economic drag from tariffs at just zero point 0.4 to 0.6% of gross domestic production, a modest cost for a $30 trillion economy. But the potential upside of tariff policy is far greater than these risks. If targeted, if targeting strategic sectors like semiconductors, clean energy, and advanced manufacturing, tariffs can speed up reshoring, bolster economic resilience, and reinforce key supply chains. In an increasingly fragmented and multipolar world, that isn't just economic insurance, it is a competitive advantage, according to this author. We've seen this playbook before, she goes on to say. In his first term, Trump placed tariffs on steel, aluminum, and washing machines and various Chinese goods. That produced limited price hikes ranging from 1.2% on cars to 12 to 17% on appliances without sparking broad one way inflation. Businesses absorbed some costs and consumers swung to substitutes or delayed purchases. The inflation bump faded quickly, dropping as low as 1.5%. The Fed was able to cut rates 3 times in 2019 to stimulate the economy, boosting gains in housing, manufacturing, and capital investment. More broadly, the trade policy helped pull some manufacturing back. From 2017 to 2020, the economy added roughly 500,000 manufacturing jobs, outpacing pre tariff growth rate. Companies like Samsung and LNG opened US plants to sidestep imported duties. Existing manufacturers expanded capacity. Though modest in scale, this shifts signaled the early momentum of reindustrialization uh, driven, one in the Biden administration later extended through industrial policy, clean energy incentives, and infrastructure investment. Today's economy is running hotter, and the scale of Trump tariffs is much greater. Yet the Fed's balance sheet is shrinking. With no expansion of the money supply, chances of sustained higher inflation remain remote. Going back to Milton Friedman's point, modest price adjustments will redirect consumer demand, easing inflationary pressures. Lower rates, in turn, would stimulate housing and investment. More factors will shape the broader outlook. Reshoring is driving new capital investment. Supply chain shortages are continuing to moderate from the COVID-19 pandemic. The stock market keeps hitting all time highs. Tariffs aren't a cure all for inflation, nor the sole engine for growth, but used with precision, they can pave the way for a stronger, more resilient economy. That's a trade worth making. End quote from this article written August 14th, 2025 by Julia Graf from Barron. So that I think is some pretty compelling data there, providing historical information, actual policy decisions, and what happened afterwards. Unfortunately, this view is not shown anywhere. You're only getting one side of a view from the media that we have in this country, and they're all siding with and it, to their help here with this, the Fed chairman himself said that this is what was going to happen with certainty, right? In the role that he's in, obviously, there's going to be a lot of people, including the news, they're just going to assume that this person's right. Now, I don't necessarily agree with that assumption because he's certainly got a lot of things wrong throughout his tenure, and we've covered all of it. But now that we have more inflation data from when this was written and when we did that podcast a couple of weeks ago, I think that the case is pretty clear that the Fed certainly got tariffs driving inflation very wrong. Now, you could say the jury's still out because there is a lag effect with every policy decision, whether it's the Fed, the White House, or what have you. So I am not narrow minded enough to think that data couldn't change over time. However, there isn't any support historically for that. And I think that this particular author, Julia Graf, did a phenomenal job of explaining this in simple terms, easy to read, easy to understand the history of it and the impact that it actually did not make on the economy's growth or inflation or any of the things that we've heard would happen from the Fed chairman himself. And that's the reason why I've had such a major bone to pick with the Federal Reserve chairman and the decisions that they've made. But I got to give them a little bit of grace too here, as we all found out here this week. The jobs revisions over the last 12 months, reducing the actual jobs numbers by 911,000 jobs over the course of 12 months.
Yeah.
For sure, and we've talked about this in another program or another podcast. We definitely need to reevaluate how the Fed goes about making their decisions. We need to reevaluate the way that we collect data and use data in this country. But if the data has been wrong, specifically on jobs, and the Fed's mandate is twofold, equally important: price stability, which is inflation. The other one is maximum employment. And maximum employment is still not a problem yet. It hasn't been a problem for a while. But if this data has been wrong to the tune of almost a million jobs over the last 12 months, how the hell could you actually make informed real time decisions? Right? That should be looked at, the process in which we collect data. No question about it. We've certainly talked about another podcast as well. Now, getting back to our expectations for this, now that we've done many, many podcasts on this topic of inflation and the Fed and rate cuts and why we thought that they should have cut rates months ago, versus what this person said in the Barron's article that I thought did a phenomenal job of laying this case out, which is a very contrarian case, specifically a month ago. But now that we have more updated data, um, I think that she was spot on with her assessment of the situation here. But now we have an interesting question on our hand. We're right here, right in the middle of September, with a Fed meeting coming up next week with all this brand new jobs and inflation data. Job market is signaling we need some help with rate cuts, and corporate earnings are fantastic, and a lot of really good reasons to be excited about the stock market and being a long-term investor. But the jobs part of the Fed mandate is saying, hey, we could use some help. So the question is whether or not we do a 25 or 50 basis point cut. Well, here's what history has to say. As for September expectations, we must consider the following question. This is what we wrote to clients in our monthly newsletter last Friday. As for September expectations, here's what we're considering. When was the Fed on hold for the entire year leading into their September meeting and then cut for the first time that year? That's the question. When was the Fed on hold for all year up until their September meeting and then did the first cut of a rate cut cycle? Well, that's happened two times in the course of history: 1998 and 2024. Now, here's the data. When the Fed has waited until September's meeting to begin cutting rates, has led to a 6.2% and 2% monthly gain respectively. So in 1998, leading into the Fed meeting in September, the S&P increased 6.2% in 1998. It sold off most of that gain post the Fed meeting, and then roughly towards the latter part of October, all the way through the rest of the year, new all-time highs substantially. In 2024, after the Fed cut rates in their September meeting, market increased 2% and sustained that rally throughout the entire rest of the year. So whether it's 1998 or 2024, the bottom line is this: after the Fed cut rates, even if it saw some sort of short-term pullback, the market was way higher than what it was before the Fed cut rates. So new all-time highs before the end of the year under both scenarios. So in other words, you can look at that and say, well, there's a 100% win ratio based on this historical precedent. Could this be the one time in the course of market history where the Fed waited all year to cut rates into their September meeting, and then the rest of the year the market didn't? It's possible, of course. Again, Past performance is no guarantee of future results. That would be a poor bet to make if that's the camp that you're sitting in. I'm betting, and this isn't me personally, this isn't what we're doing for clients, but if you're listening to this data and you're like, I still think this market's going to suffer for whatever your reason is, and maybe you don't even have a reason, maybe you just have a gut feeling, which is what most people might say. In my experience of doing this for folks for basically 15 years now, that's might what you it might be what you have to say. Maybe it's even just a personal feeling. This is the data. The data suggests that there's a 100% win ratio for a market rally, whether it's before or after the Fed cuts rates here this September. History says when they've waited all year to cut rates and then finally do it in September, the market rallied to new all time highs before the end of that calendar year. Now, our view, this is Shepherd Wealth Management's view, my take on this based on some of this data. Our view is for the month of September is actually contrarian to history. The month of September historically is difficult for investors during the first year of a presidential cycle. It actually shows, on average, the S&P average monthly return since 1927 in the first year of a presidential cycle, which is what this is, shows a negative 1.6% return in the month of September. We think that this is actually going to be a positive month for the S&P 500 in September, and we're going to give you a couple reasons why. And we're certainly going to point to history as reasons why we believe this. The U.S. money supply. So we talked about Milton Friedman's famous quote there that inflation's always a monetary phenomenon. Too much money chasing too few goods. The U.S. money supply, or M2 for those finance folks, just hit a record of 22.1 trillion in July of 2025. Liquidity injections have historically fueled sustained rallies. So not just um, injecting a rate cut, but liquidity. A lot of money out there. That's what the money supply is. 22.1 trillion, a record as of July of 2025. Uh, Historically fueled sustained rallies. So where can you point to? 1975 post recession, 1982 post the Volcker pivot, where instead of increasing rates to stave off the worst inflation in the history of mankind here in the United States, they begin to pivot. 2009 post Great Financial Crisis. And by the way, the 2009 scenario there, market started to recover in March of '09. Even though history would support everything I'm talking about here, you could have looked back and said, okay, the Fed was engaged in 1975, 1982. Now they're engaged in 2009. What was the history of that? You could have pointed, even though you felt terrible in 2009 if you were an investor at that time, because you just experienced the worst decline in the S&P 500 since the Great Depression of 1929. I go on. Lastly, 2020 COVID, massive liquidity injection, Fed cutting rates, fiscal stimulus led to a substantial rally, also caused, in hindsight, the inflation problem that we had to deal with. Another reason why we believe that this trend will be bucked in the first year presidential cycle for the month of September regarding S&P performance. Each of those years was followed by multi-year bull markets. Today's money supply M2 trend, combined with the upcoming Fed rate cuts, suggests we may be setting up for a similar extended rally in our view. Per history, 100-day stock market rallies usually represent the beginning of a rally, not the end, especially given all the cash sitting around in money markets. So market's done great for the last 100 days. It's usually not the end, specifically when there's a ton of money out there in circulation. The Fed is on the precipice of cutting rates and will continue to cut rates. And history says, under these scenarios, markets do fantastic. And we can point to a couple other points here as well when we're talking about money supply. So, with the M2 money supply elevated, the passage of recent tax cut packages as well, and the Fed nearing the beginning of a rate cut cycle, this looks much more like 1982, 2009, and 2020. And to put a finer point on it, since 1980, when the Fed cuts interest rates after the S&P 500 is within 2% of an all-time high, which is where we're at right now, this has worked out very well for investors. The average return over the next 12 months was nearly 14% with a 100% win ratio under those historical precedents. So you have a ton of reasons to be very bullish, um, not just leading into this Fed meeting, but also everything that we would expect to happen after that. However, as your favorite measure of consumer sentiment, the AAII net bulls,
I
this
love
is
the AAII net bulls. I love it.
this this is no joke. This is an unprecedented bearishness. Despite all-time highs of the S&P, there are still more bearish investors than bullish investors over the last 5 weeks. Again, this is why I saved that article um, that was written August 14th. Usually, you would see this sort of unprecedented bearishness during an event like a 2009. I mean, even in 2009, investors weren't this bearish. You know, I should have gave you this chart as to post up somewhere, you know, around where I'm talking about here for viewers to see. Obviously, our clients certainly benefited from this. Um, but this is I mean, I'm literally looking at the data here right now. The only time it got this low since 2001 was COVID. I mean, we haven't seen investors this bearish since the news of COVID happened. And I've just rattled off all kinds of data as to why not only the Fed should have cut rates earlier this year, why they definitely should be cutting rates now, and why you should be a bullish investor, even though September historically isn't a great month for investors. And we'll have something to say about October here in our next podcast. So stay tuned to that. There's definitely a lot of history with the month of October, especially after the Fed starts to cut interest rates. We'll dive into that. But this is part of the reason, on top of all the other reasons we just laid out, is why we feel that this September, any pullbacks will be very shallow and buyable. And that's exactly what we've been doing for our customers during the month of September here and parts of August, as historically that's not great times to be investors. So what are we doing based on all this historical data? Understanding that the market's win ratio when the Fed starts to cut interest rates for the first time of a rate cut cycle is very bullish. Corporate earnings have been phenomenal. Markets up double digits, even though you got the most bearish readings on investor sentiment surveys, and you have $7 trillion sitting in cash after all this awesomeness has happened in the S&P and the Nasdaq and the Dow Jones. People missed it. So human beings have this fear of missing out. I think we would all agree. Any dips in the market will likely be bought because people have missed out on a double-digit return on the S&P 500, and that is going to drive some of their own decisions throughout the course of the rest of this year. So, if you're in cash or if you're considering going to cash, please take a step, take a moment, breathe, maybe re-listen to everything I just laid out here, and if you still have questions, give me a call, 513-630-2664. Be happy to talk about this with you. But that's the reason why we're in the position that we're in here, having the success that we have for our customers has very little to nothing to do with myself and my team being the smartest person in any room that we walk into, but it does have everything to do with having an investment process that solves for the number one hurdle that you'll have as an individual investor, which is controlling your emotions. Why that's so difficult for you is because we as humans are hardwired with a lot of emotions, two of which stand out when it comes to investing: fear and greed. And thanks to studies like behavioral finance, we fully understand that human beings are not only hardwired with these emotions of fear and greed, but we feel losses emotionally twice as much as we would feel good about any amount of money or gain that we would have. That just makes us risk averse by nature. So if you were a participant in this rally, um, you might be saying to yourself, well, can this continue? Well, if you don't have a historical lens to look through, how could you possibly address that question if all your information is going to come from news media, the stuff that we're hearing right now here today. You can't have a clear understanding of risk reward. You're hardwired to be more fearful to protect that gain, right? That's why you're considering going to cash, even though I've just laid out a lot of historical reasons why you should not consider doing that. And of course, by the way, we don't make recommendations to the audience as a whole. We only make recommendations to our individual customers specifically because we understand their situation very, very well. We meet with them regularly. But I'm happy to take your question if this is something that you're dealing with in your own situation right now. And if you haven't participated in this rally and you're trying to figure out what to do, well, I just again gave you a lot of reasons why you would want to be a market participant. I can't give you unsolicited advice on how to go about doing that because you're not my client. And that's not what this particular platform is all about. But what you can do is you can take this information, you can use this historical data to develop an asset allocation that you want. If you could get in the market today, this is what I would want to do based on all this historical data and my own personal goals and objectives. Now you can have a game plan for dollar cost averaging the cash that you've been sitting on, that trying to find a way to participate in this bull market that we are still in. And based on history, likely will continue to see happen over the course of the next several quarters. And we'll talk about all 2026 here in the not too distant future as we transition into Q4, as we turn the page away from September and into October. So I hope that you'll be with us at the Shepherd Wealth Management Podcast. Please like, share, and subscribe to Shepherd Wealth Management Podcast, your friends, family members, and coworkers. Please leave your questions and comments right here on YouTube or go to shepherdwm.com, a brand new website. Whole bunch of data about myself and the company that we built here and what we're here to do. All the ways to get a hold of us so you can leave your comments and questions. And I'd love to have the opportunity to have this discussion with you. Whether we end up working together or not, love to have the opportunity to work for you on your behalf and driving similar results that we have for our customers over the course of the last 4.5 years, where, by the way, there's been a lot of bad headlines over the last 4.5 years. We have video evidence over the last 4.5 years of covering all of it, what we're doing and why, and what does history have to say about it. Because of those processes that we've developed and implemented on behalf of our customers, that's led to a business that's growing and thriving. It's led to lives that have been changed financially. And it's led to peace of mind for those that didn't have it previously to working with us. And it, again, has nothing to do with me being able to read more books faster than you or read a balance sheet or an income statement better than you. It has everything to do with listening to the words of wisdom from the greatest investor of all time and developing a process similar to his that solve for those biggest problems that human beings cannot inherently be born out of. We are hardwired by creation with these emotions. I am here to solve or help you solve or find ways to address these problems. And I love to have the opportunity to do that for you and your family. So check us out here about every 2 weeks. We'll be back here again to deliver content in 2 weeks. So we look forward to doing that. I hope you guys have a great rest of your Thursday. And God bless.